Daniel was, by any visible measure, doing well. He was 34 years old, held a senior position at a mid-sized logistics company, and brought home a salary that placed him comfortably in the upper middle income range. He owned a late model car. He paid his mortgage on time every month. He contributed to his retirement account. He took one overseas vacation a year. To the people around him, and to himself, Daniel had achieved a version of financial competence that most people spend their 20s working toward. Then one Tuesday morning in March, his company announced a restructuring. His division was being absorbed into another. His role, as it currently existed, would no longer exist in 60 days. He would be considered for internal transfers, but nothing was guaranteed. Human Resources gave him a folder with paperwork. He thanked them, walked his car, and sat in the parking lot for 20 minutes trying to understand what he was actually feeling. What he felt was not grief, and it was not quite panic. It was something more precise than either of those. It was exposure, the sudden, clarified awareness that every single financial commitment in his life, the mortgage payment, the car payment, the insurance premiums, the credit card he paid in full each month, every single one of them was dependent on a single paycheck continuing to arrive, and it would stop arriving in 60 days. Daniel had, in the technical sense, been financially responsible. He had not accumulated consumer debt beyond what he could manage. He had invested. He had not spent recklessly. And yet, sitting in that parking lot, he realized that he had approximately 6 weeks of actual cash available to him, not invested, not in equity, liquid, available without selling something or borrowing something. 6 weeks against a financial life that had been built on the assumption that the income would simply continue. This is not an unusual story. In fact, it is closer to the norm than most financial advice would have you believe. And it raises a question that sits at the center of this documentary. What does it actually mean to be financially secure? Is it about what you earn, what you own, what you have invested? Or is it about something quieter and more fundamental than any of those things? There's a version of financial wisdom that has become so widely repeated, it is now treated as obvious truth. The argument goes roughly like this. Cash sitting in a bank account earns almost nothing. Inflation erodes its value over time. The intelligent thing to do with money is to put to work, to invest it, to generate returns. Idle cash is wasted potential. Every dollar sitting in a savings account is a dollar not growing in the market. This argument is not wrong. Exactly. The mathematics are accurate. Money invested over long periods does, historically, outperform money held in cash savings. Inflation does erode the purchasing power of idle currency. These are real and important facts. But the argument is incomplete in a way that creates genuine financial vulnerability for the people who follow it most rigorously. It treats cash as if its only function is to grow, and then, having found it inadequate at growing, dismisses it. What this framing misses entirely is that cash is a function that no investment can replicate. Cash is immediacy. It is availability without friction, without penalty, without the requirement that you time a sale or wait for a transfer or accept whatever the market happens to be offering on the day you need the money. No other financial asset does this. Stocks can be sold, but only at a price the market determines, and only after settlement periods that may not align with your needs. Property is value, but converting that value to cash is a process measured in months, not days. The financial planning industry tends to value what can be measured and projected. Returns can be modeled. Compound growth can be charted. The value of having cash available when an opportunity appears, or when a crisis arrives, or when negotiation gives you leverage is much harder to quantify. It does not show up in a portfolio statement. It does not generate a percentage gain, but it creates something that no percentage gain can buy after the fact, and that is optionality, the ability to choose, the ability to act. When financial advice undervalues cash, it does so by evaluating it solely on what it returns in normal, stable conditions. But financial life is not lived entirely in normal, stable conditions. It includes job losses and health emergencies and market downturns and unexpected opportunities. In those moments, the question is not what grew the fastest over the last decade. The question is what is available right now, and only cash answers that question cleanly. Consider what it means to have genuine financial optionality. Not theoretical options, but real executable choices available to you in any given moment. When you have cash reserves, you can choose to leave a job that is making you miserable without immediately facing a financial crisis. You can choose to take a month to think carefully before accepting the first offer rather than the best offer. You can choose to invest when markets fall rather than sell because you need the money. These choices are not available to everyone equally. They are available in proportion to how much liquid financial buffer you maintain. This is a form of power that rarely appears in personal finance discussions because it is difficult to price. How much is it worth to be able to say no to a job offer that does not meet your standards? How much is it worth to be able to wait 3 months for the right buyer of your property rather than accepting below market value under time pressure? How much is it worth to walk away from a negotiation that does not serve you? These are real advantages that accrue to people with cash reserves. They cannot be quantified, but they are experienced daily by people who have them and denied daily to people who do not. There is also a negotiation dimension to cash that is almost never discussed. When you are negotiating from financial pressure, the other party can sense it, not necessarily because you disclose it, but because pressure changes how you negotiate. It shortens your time horizon. It makes you accept terms you would otherwise push back on. It makes saying no feel dangerous rather than strategic. When you negotiate with genuine financial stability behind you, the psychology is entirely different. You are solving a problem. You are not managing a crisis. That difference produces better outcomes in almost every scenario where money is involved. The stress reduction that comes from cash reserves is not merely a comfort. It has a direct effect on the quality of decision-making. Research into financial stress consistently shows that people operating under financial scarcity devote significant cognitive resources to managing that scarcity. The mental bandwidth consumed by worrying about whether income will cover expenses, or how a payment will be managed, or what will happen if something unexpected occurs, is not available for strategic thinking, creative problem-solving, or long-term planning. This is not a moral failing. It is a cognitive reality. Scarcity narrows attention. Having a cash buffer, even a modest one, frees cognitive resources that can then be applied more productively. Opportunity readiness is the final hidden advantage worth examining carefully. Significant financial opportunities rarely announce themselves with sufficient advance notice to allow people to prepare. The investment property that comes available at a favorable price. The equity stake in a small business that a colleague is willing to sell. The moment in a market downturn when assets that have been overvalued for years suddenly become accessible at rational prices. These windows open and close on their own schedule, not on yours. The person with cash available can move through them. The person without cash can only watch. Consider 2 people at the same income level, both earning 6 figures, both in their mid-30s. Call them Sarah and James. Their salaries are nearly identical. Their lifestyles from the outside look similar. They live in comparable neighborhoods, drive similar cars, and eat at the same kinds of restaurants. The financial difference between them is not visible in how they live. It is structural, and becomes visible only under pressure. James has optimized his financial life for growth. He invests aggressively. His retirement accounts are well-funded. He carries a manageable mortgage and minimal consumer debt. Every dollar above his monthly expenses goes directly into investments. He believes, not unreasonably, that this is the disciplined approach. His net worth on paper is impressive, but his liquidity is thin. He keeps roughly 3 weeks of expenses in cash at any given time. This feels fine to him during the years when nothing unexpected happens. Sarah earns the same amount and invests meaningfully, but she maintains a cash reserve equivalent to 6 months of living expenses. To James, this looks like a missed opportunity. That money is sitting in a high-yield savings account earning a real but modest return. It is not compounding in the market. It is not growing at the rate that James's investments are growing. From a pure return perspective, Sarah appears to be leaving money on the table. Then a year arrives that tests both of them in different ways. James's company goes through a difficult quarter and lays off a portion of his division. He is among those let go. He has strong references, marketable skills, and confidence that he will find a new role within 3 to 5 months. But 3 to 5 months of expenses, with a mortgage and 2 children, is a significant sum With 3 weeks of cash available, he has two choices: begin selling investments or use credit. He does both. He sells some equity at a moment when the market happens to be down. He accumulates credit card debt at interest rates that erase any investment gains he might have made in a normal year. By the time he lands a new role, the financial cost of the gap is substantially larger than the gap itself. In the same year, Sarah's landlord offers to sell her the apartment she has rented for 4 years at below market value because he wants a quick, clean transaction. She has the cash for a down payment readily available. She does not need to liquidate anything, negotiate a timeline, or scramble for financing under pressure. She completes the transaction on terms that suit her, secures an asset she wanted, and continues her life without financial disruption. The cash she had been holding, which looked like a missed opportunity throughout the years she maintained it, paid for itself many times over in a single transaction that required immediacy. The same income, the same general discipline, radically different financial experiences when reality introduced variables that neither of them planned for. That is the difference between optimizing for returns in normal conditions and designing for resilience across all conditions. There is a concept worth naming with more precision than it usually receives. Call it financial breathing room. It is the gap between what you need to survive financially and what you currently have available. When that gap is wide, you breathe. When it is narrow, or when it closes entirely, the experience is not metaphorical. It manifests physically as tension, disrupted sleep, difficulty concentrating, and a persistent low-grade anxiety that colors every interaction and decision. Financial breathing room is not the same as wealth. You can have a high net worth with very little breathing room if your assets are all illiquid or encumbered. You can have a moderate income with substantial breathing room if your expenses are controlled and your cash reserves are maintained. The variable that determines breathing room is not what you earn or what you own. It is a ratio between your liquid resources and your obligations in any given period. Most people who live paycheck to paycheck are acutely aware of the absence of this breathing room. What is less recognized is that many people who consider themselves financially comfortable are also operating with far less breathing room than they realize, because they have converted almost all their financial resources into forms that cannot be accessed immediately without cost or friction. They have assets but not liquidity. They have net worth but not flexibility. They are one unexpected expense away from a situation that feels significantly worse than their balance sheet would suggest. Building financial breathing room is not complicated, but it requires resisting a set of culturally reinforced financial instincts. It requires holding back a portion of your income from investment. It requires accepting a lower return on some of your money in exchange for the optionality and stability that only immediacy provides. It requires thinking about your finances not just in terms of what they are worth, but in terms of what they can do for you on any given day without notice. One of the most counterintuitive aspects of maintaining cash reserves is that they actually improve long-term investment performance, despite earning less in the short term. The mechanism is psychological, and it is more powerful than most investors acknowledge. When a market downer arrives, as they periodically do, the investor's primary danger is not the decline itself. Prices fall and prices recover. The historical record on this is consistent. The danger is behavioral. The danger is selling at the bottom because fear and financial pressure become overwhelming. The investor who has no cash reserves, who has invested every available dollar in the pursuit of maximum returns, is paradoxically the most vulnerable to the worst behavioral mistake in investing. When the portfolio falls 20 or 30%, and they simultaneously face some unexpected expense or income disruption, they are forced to sell. Or they watch the numbers fall with a level of anxiety that is genuinely destabilizing, because the portfolio is not an abstraction. It is everything. Every available resource is in there, and watching it decline feels like watching the floor disappear. The investor who maintains a meaningful cash reserve experiences market downturns differently. The portfolio declines, but the portfolio is not everything. There is a buffer. The monthly expenses will be met regardless of what the market does this quarter. The cash reserve creates enough psychological distance from the market's movements to allow rational thinking to operate. And rational thinking in a market downturn looks like patience, or better yet, like opportunity. The person with cash available in a significant downturn is in a position to buy, not to sell, over a long time horizon. The difference between being a buyer in a downturn and being a foreseller is enormous. This is why the relationship between cash and long-term investment performance is not a trade-off in the simple sense. Yes, cash held in reserve earns less than equity invested in normal conditions. But cash held in reserve prevents the catastrophic behavioral errors that destroy returns in abnormal conditions. It is insurance against yourself, against the version of you that exists under maximum financial stress, making decisions that the calmer version of you would immediately recognize as mistakes. There is a specific form of financial dependency that develops in people without adequate cash reserves, and it is worth examining because it is both pervasive and rarely named. When you have no cash buffer, your financial life is entirely synchronized with the timing of your income. Every obligation must align with every payment. There is no slack. There is no room for the unexpected. The whole system operates like a machine with no tolerance. When everything functions exactly as predicted, it works. The moment any variable deviates, the stress becomes immediate. This dependency on income timing is not just uncomfortable. It actively limits your options in ways that compound over time. You cannot take career risks because any gap in income will be immediately destabilizing. You cannot negotiate your employment terms from a position of genuine willingness to walk away, because walking away is not a real option. You cannot wait for the right opportunity when an adequate one is available, because adequate is all you can afford to accept. The absence of a cash reserve does not merely create financial vulnerability. It creates a kind of professional and personal contraction that gradually narrows the range of your life. Credit can appear to solve this problem, and for short periods it does. Debt creates immediate access to money that has not yet been earned, which solves the timing problem in the moment. But debt is not a substitute for a cash reserve. Debt is borrowed breathing room that must be returned with interest. The person who uses credit to manage cash flow variability is paying a premium for the flexibility they could have provided themselves for free through disciplined saving. And the interest payments on that debt make it harder to build a reserve that would eliminate the need for the debt. It is a reinforcing cycle with no obvious exit, except the discipline to break it deliberately.